I'm Sophia Tupolev, and this is your TV10 Daily Edition with the top stories today in Israel's business community. Inside today's edition, if you subscribe, job seekers spiked 18% in a single week. The Bank of Israel's foreign exchange reserves dipped to $228.27 billion. The Israel Tax Authority is officially widening 2026 income tax brackets to offset inflation. In capital markets, the local bond market demonstrated remarkable resilience amid the Iran conflict. Kornit Digital acquires Dutch software firm Print Factory. And finally, the newly privatized Israel Post taps former El Al executive Ronen Galperin to lead its financial arm. Let's take a closer look at the macroeconomic toll of Operation Roaring Lion. As we wrote yesterday, the Ministry of Finance estimates the direct fiscal cost of the conflict at 35 billion shekels, around 1 billion a day, with the defense establishment eating up roughly 22 billion of that total for immediate operational costs, munitions, and reserve mobilization. And the kinetic phase might be triggering an immediate labor shock. The Employment Service reported an 18% weekly surge in job seekers, pushing the national total to 360,000 people. Most alarming is the 41% jump in workers placed on unpaid leave, called chalat, adding nearly 48,000 furloughed employees in a matter of days, for a total of 164,210. What does this mean? The sheer velocity of the labor market's contraction may expose the fragility of Israel's wartime civilian economy. While the Ministry of Finance trumpets its 12 billion shekel business compensation and furlough packages as a stabilizing force, a 41% spike in furloughed workers in a single week is not exactly a sign of resilience. It is a glaring signal that SMEs, small and medium enterprises, are pulling the emergency brake on payrolls. The state is essentially socializing the cost of private sector paralysis, absorbing tens of thousands of salaries onto the public balance sheet at a time when the military is burning through nearly 1 billion shekels a day. The Bank of Israel reported a $6.27 billion drop in its foreign exchange reserves for March, bringing the total down to $228.27 billion. According to the central bank, the vast majority of this decline was driven by downward asset revaluation in global markets, which was partially offset by government foreign exchange activities. Despite the drop, reserves remain at a historically robust 37.2% of GDP. In a parallel move to ease the domestic squeeze, the Israel Tax Authority announced the official widening of the 2026 income tax brackets. This fiscal adjustment is designed to offset inflation, effectively increasing the net pay for middle and upper middle class wage earners, specifically those earning over 193,800 shekels annually, by ensuring that nominal wage increases meant to match inflation do not push workers into higher tax brackets. On the monetary front, the Bank of Israel's FX reserves remain a formidable sovereign fortress. For foreign investors, the 6.3 billion March contraction, and that's dollars, $6.3 billion March contraction, should not be misread as capital flight. It was primarily a paper loss driven by global market revaluations. The fact that the Bank of Israel maintains a war chest equivalent to 37% of the national GDP proves the central bank still has immense untapped firepower to defend the shekel and ensure systemic dollar liquidity if regional geopolitical friction reignites. However, the juxtaposition of the 35 billion shekel deficit injection against the tax authority's bracket widening highlights a severe structural paradox. The government is aggressively bleeding capital to fight a multi-front war and bail out frozen businesses, while simultaneously reducing its effective income tax yield to throw a lifeline to a middle class drowning in inflation. The math simply does not align. This fiscal tightrope walk points to a severe deficit breach later in 2026, which may force the Treasury to issue a massive wave of new government debt, crowding out private investment just when the economy needs it the most. And another story from our daily edition that I'd like to take a closer look at. A major executive shakeup may point to a shift in the local financial sector. Israel Post, recently privatized under the ownership of the Milgam Consortium, has appointed Ronen Galperin as the new CEO of Postal Finance, its financial arm. Galperin previously served as the CEO of El Al's frequent flyer program, where he managed the highly lucrative fly card credit operation, generating 170 million shekels in net profit and driving the subsidiary's valuation to roughly 2.7 billion shekels. This executive shakeup at Israel Post could potentially be a blinking red warning light to the domestic banking sector. Under Milgom's new private ownership, the Post could leverage its sprawling physical retail footprint, there are branches everywhere, and vast customer database into a high margin fintech operation. Possibly by poaching Ronan Galperin, the architect who built El Al's fly card into a nearly 3 billion shekel consumer credit juggernaut, Milgom could be signaling its intent to bypass legacy banking. Sounds like more than a modernization of the national mail service, which we all love to hate, and possibly the groundwork for a bank poised to launch a highly competitive assault on consumer credit margins. That's a story to watch from my perspective. These and other stories in our daily edition newsletter. Visit TV10 on Substack to subscribe. And we'll see you tomorrow.